Hello and welcome everybody to our weekly episode of MoreTalk, which is for those listening on Spotify and our YouTube podcast stations where many people are coming now. Please give it a subscribe. And if you ever want to participate, we try to be the only live show in mortgage right now. And by mortgage, we mean if you're a real estate agent, a loan officer, processor, underwriter, whatever you are, understanding what the leaders of the mortgage industry are battling against right now, what they're going through, and how much opportunity is where the puck's going, as they say. If you want to be part of all that and you don't have access to maybe all these conferences, we try to be the place to do it. And it's not just listening. You can participate. You can follow hashtag MoreTalk, MoreTalk, and come on our live LinkedIn audio, which is every Thursday at 2 p.m. Eastern and
11 a.m. Pacific in sunny San Diego, of course.
So, Michael, I was going to start the show with a quick rant and then go over to our guests.
So appropriate.
Right? Well, here it is. And these thoughts are on the rumor mill, not so much my own, but to be repeated and thought of, as an innovator, and somebody's got to take the role. We actually have a lot of entrepreneurship on the show today, but somebody's got to take the role of at least going against the grain. And the grain is obviously from all of these podcasts that the mortgage industry has taken a real big stance, I think, on just playing real nice with the real estate agents, which makes sense on the retail side. That's their peers. Those are the people they respect how much work they're doing and have done. And they're going to go ahead with everything's going to remain the same. They'll just have to figure it out. Things are going to be a little bit different. We'll get into this a little bit later in the show, as the Lyons does a lot of work with VA and what NAR asked VA to do today. But I just question, is the real estate agent side playing so friendly? There was a CEO of a top real estate company.
No.
Brand. Oh, yeah. He's on record being in front of all of his agents a little over a year ago saying, and I think I said this last week, don't forget, real estate agents, we bring 67% of the referrals to the mortgage loan officers. We're the dog, they're the tail, right? Obviously, that dynamic could change here. And I've heard from the birdie from Washington, D.C., the one that has more info than anybody I've ever met. And I talked, I'm trying to be a sleuth in some ways, not on purpose, just by talking to people. From what I'm hearing now, and you'll hear it here first because no one else is talking about it, but what if these big real estate agents, what if, quote, quote, these big brokerages are trying to find a way and working with certain technology providers in the mortgage industry to own the underwriting, but not the fulfillment of the loan? And it just got me thinking. So, that's fact. If I hear from the birdie, something's happening there where there's smoke, right? So it just got me thinking, these big names, these big real estate companies, and I don't know which one it was in that particular case, but let's just call big names big names. You got EXP, you got Kelleher Williams, you got, right, Coldwell Banker. What is happening on the lender side? Are the big lenders having discussions and I would think this is sort of in DC and sort of in that areas where it starts, or maybe at the trade group. So they're talking with NAR about it, places that are well-funded. So I guess on our side, it would be the MBA. I don't know if we have one on the mortgage side, right? I don't know if we have enough lobbying. I don't know if the MBA is strictly advocacy and not like NAR and all them technically own MLS at the state level, not really at the national level. They own Realtor.com, which has more eyeballs than anything that the MBA owns. And the MBA really doesn't have, you have Mismo, but nothing's, we'll save Mismo for another day. Mismo's great, but it's only as great as really Encompass is willing to work with it, I think. And this is a little bit controversial here to certain big companies, but is anybody on the mortgage side having these same talks of, could we take over the buyer's agent real estate side? And if they are, I haven't heard it. I've now seen a million webinars, and it's all forward facing on the mortgage side that the real estate agents will figure it out. And we're going to be right there with them, and we'll figure it out with them. And you don't have a dentist, right, doing x-rays on breaking a wrist. But we talked about this last week with Clayton Collins from Housing Market, right. Jay Promisco with Sierra Pacific. I disagreed a little bit on that one, sort of. I just think it's different. I think people YouTube now, maybe the doctor one's a good analogy, but they were going with plumber, right?
Wow, we've been talking about this not just last week, but for several weeks, where it's originators that have the opportunity to go get the business. It's somewhat of a lazy way out for a mortgage originator to keep asking the realtors for the business. And especially now that the commission tables have somewhat turned on the real estate industry to realtors, trademark with the R, that all of a sudden, hey, you know what? Now, look, realtors are going to figure out how to get paid no matter what. Whether it's 2.5%, whether it's 3%, whether it's 1%, they're going to figure it out. But originators, for as long as I've been doing this for over 25 years, have always figured out, hey, we always have to ask the realtors for the business, but not actually, and the MBA hasn't done a very good job of saying, hey, go and do your, we've been telling you to be a value proposition lender for years and years and years, fiscal literacy, all these things, and yet are saying, hey, we control the buyer, we control the buyer, we control the buyer. Really, it should be originators that control the buyer, because why? They control the money. I always thought that whoever controls the gold makes the rules. And yet the realtors are the ones saying, hey, we are the dog wagging the tail, when it really should be the other way around. And I'm with you, Mike, that it frustrates me on this one. And I'm more in agreement with you. And I do think that we have a chance with the MBA to put a dog in this fight, as far as originators and mortgage bankers and brokers alike have a say in this show, as far as where the control of the buyer can and will be.
And we'll get it. I mean, we have the ultimate entrepreneur who came up with their own platform, Bill Lyons, who looks like he'll be jumping on in a minute. You say he who holds the gold makes the rules. Always applies, except the system was set up where you didn't need gold to work with a buyer's agent. That's why you didn't use attorneys, because attorneys, technically, I was talking with somebody today, you would say, well, you could end up spending $150 with an attorney to look at this purchase and sale. And if you don't close with them, you're still going to owe them. With us, you don't owe till the closing, and we know how to read it, and we have people in. Well, now, if that is decoupled out of the mortgage, then gold does matter. Like before, I guess, I think you know what I'm trying to say. Like, you didn't need to pay for anything up front. So everybody went with the least resistance, which was that. If that goes out the window, we could talk about it a little bit later. I just think there's no way tech companies aren't going to come in here because of the mobile phone and be able to FaceTime on a walkthrough. There's a company in New York now that actually delivers a package via drone. The courier delivers the package within an hour to the front steps. You open it up, and the drone comes out and goes through the house and takes care of the walkthrough for that's in replace of the agent walking through it. So you can't tell me the tech is not in that way. And the only way to know this stuff is come to our show or go to conferences. And we really would love some people in the audience to come up when they come on Thursday, so that the listeners on the podcast understand that it is a call-in show. So if any of you have been to a conference recently and have something insightful to say while we wait for Bill, we were anyway going to segue to this part. For those on here to hear Bill, our goal is to introduce him, well, right around now, but we're a couple minutes behind. So real quick, Jordan, do you want to quickly, I got to do better at the introductions too, because on the playback of YouTube and Spotify, Mike, I don't know if you noticed, it's hard to tell who's who when we have too many guests. So we can solve that pretty easily. Jordan, do you want to introduce yourself briefly and just tell us about the ICE conference before we get into, talking with Bill and going down the niches and riches route?
Yeah, absolutely. So, Michael, appreciate the opportunity to jump on with you guys. My essentially business model is to help lenders and connect them with those service providers, servicers, and capital market relationships that I've gratefully been introduced to and or formed almost family type relationships with over the last 23 years doing my business, and broke out about a year and a half ago. And same for you, Michael, doing the same thing, breaking out and doing all the content that you're doing. I think it's great. And we see each other at the conferences all the time, and happy to be able to join on and jump on one of your production.
Yeah, this show's like to find the next Bill Lyons, the next, when Bill Dallas was on here, he said Victor Shirelli, even Chris George were brokers to him. And now look where they are. What would you say for those that can't make it to the ICE, like the conferences you and I make, from what you saw at ICE, what can that next broker learn, and how can they, become a next big lender 5-6 years from now? Anything they're seeing?
Absolutely. I think the ICE conference by far in the origination space is one top of the list when it comes to the opportunity. One, they always hold it at a great venue, beautiful area there in Vegas at the Wynn, and they get the right people there. And of course, it's tailored and catered to their users and those vendors that are integrated and provide a lot of amazing solutions. So those that attend, you get the hands-on experience. I mean, you get to see firsthand whether they're exhibiting or being able to sit down and meet with them to understand the new, latest, greatest service solutions, service provider, tech, all the above, to be able to improve your lending process, to be able to improve the efficiency of how long it takes to do a file, and to take full advantage of all of the data that's out there, direct integrations to actual data sources. And I think that that's very key. And coming into 24, we know that 23 was a building time, a revamp, relook at your process, and 24 coming into it, I've been working with a lot of partners, and that continues because you know that when their times are a little on the low side or slow side, that's a great time to start working on improvements for when it comes and it starts to rain, that you're able to keep up and make it happen.
Was there any talk out at the bars, where you get a little bit of truth? Is it just like there were too many loan officers in the industry? I guess at one point when inventory really stopped in 2022, are there too many vendors right now and trying to figure out if there's going to be consolidation on the vendor side, or can vendors sustain the investment needed on the technology side, giving variety in categories if this inventory is so low or production so low?
I mean, absolutely. I think the big thing, you talk about the loan officers. There's some fun stats out there about how many are exiting the business. And no matter what industry you're in, from a sales approach, you've always got the players and the pretenders. And I think that can as well migrate over to the vendors and service providers. I'm a big proponent of calling vendors partners because they truly want to partner with you to improve business. But I think that innovation is key in all things, and somebody sees a need and fills a need and they create a business and make it happen. I think attrition and acquisition is going to happen just by default, where larger companies almost have to acquire to keep margins and volume going. But also there's a lot of new and up and coming providers that are a good complement or very synergetic to their offering today. So I think that that's just natural that there's a partnership, a JV and acquisition, and will ultimately contribute to some, dialing down of the total number of vendors out there because of the ability to get so much quality data. There's only a handful of people that can get that. And so there's a number of resellers.
I think the efficiencies and the technology have been tremendous in what they've been able to do, yet the cost of a mortgage still continues to go up. I think that a lot of that has to do with lack of regulatory clarity. But where it ultimately will win out is when it's all put together and flows to, I think, the consumer direct model will have such a resurgence, and it probably already does, but it'll have such a resurgence when their loans are priced that much better and their loan officers have sales ability, not just in networking, but in the ability to help consumers understand the best products. And one of the North Stars here is you, Bill. If you could just introduce yourself, because on the replay on the podcast, so people can associate your voice with your background. I love to point out that you started, I think almost twice. Once you were a branch in San Diego for a broker building up to $18 million a month. That's just such a big number for yourself before you even go out on your own. And then you actually built a company up to $1 billion. And then that was before you even started Griffin Funding in 2013. So outside of that quick background, anybody listening, hopefully there'll be a couple that do that in the future from these shows. What more could we say about you?
Yeah, I live part-time in La Quinta outside of Palm Springs. I live most of the year in Tahoe in Incline Village, Nevada. And of course, I commute to the office in San Diego. We've been profitable last year, part of 2022. We took a little bit of a hit at the beginning of 2022. And thus years so far, we're this month having our biggest month since March of 2022. So, I wouldn't call it a record month, but it is kind of a record because it hasn't been done in over 2 years. So grateful for what we're doing. Obviously, I have a lot of help from the team that I work with. Profit's a choice, and we're a profitable company, which probably less than 5% of the mortgage brokers, bankers out there are profitable. People are bragging about volume, but volume doesn't matter. Revenue doesn't matter. That's teenager talk. Adult talk is profit. And I think that, being involved with a company that's profitable, whether you're on the ops side or the origination side, is really important in this market. So glad to be on the podcast today. I've been in the business 23 years and looking to scale Griffin Funding pretty hard this year. So I'm excited to be on the podcast.
I think profitability is a culture almost. I came to learn that through Terra Verde, which is really where I first, after your email challenge, actually, is where you first popped up on my screen. So you actually had all your members delete old. I know this because I am a habit of going back to old emails and saying I'm going to clean it out one day and never do. And it just takes up time and probably is not the right thing. And when I saw you do that, I'm like, I should just do that. But what about all these golden nuggets I'm going to lose from 2018 that are still in there? Do you want to just talk about that? I think it's years ago now at this point, but it just stood out to me. Maybe just touch on that real quick.
I think it was the beginning of 2022 or beginning of 2023. I just said, hey guys, everything that happened in 2020, 2021, 2022, let's erase it and start over. So I had everybody, some people erase, some people use the archive feature, but just archive everything down to a zero inbox. I was listening to Andrew Huberman podcast this morning on the guy from Deep Work. I think his name is Cal. Can't remember his last name. We'll have to look it up. But he wrote the book Deep Work, and that we live in a world of distraction, and that we have cognitive disabilities and cognitive distortions because we're constantly distracted with email popping up every 5 minutes or social or whatever it may be. So I think the key is making sure you can control what you can control and eliminating distractions, because they will pull at you every single second of the day, and doing deep focused work will keep you on track. So that was the point of doing the email, but it was hard, but we all did with a clean slate.
I think a big question people are going to have is, how many times did somebody say to you, oh, I can't find that email because it got archived or deleted?
I mean, look, Magnum PI drove around his Ferrari in 1984 and didn't have a phone, and he lived a great life. So, sometimes you miss some things or you have some FOMO or whatever. But if you set those expectations with people, if it was really important, you would drive down to the King Kamehameha Club and find me. That's kind of the thought there. And I didn't get one email of, hey, remember that from a year ago that we were talking about, because it wasn't as important as I thought it was.
Yeah, it reminds me of the junk drawer. Or I've seen two funny skits on Instagram. One is, grown up dads with his father, and he's just fixed the bed for the kid from a crib to a bed. And it's wobbly. And the father, the 70-year-old father's so happy to go down to his garage for this piece of wood that he's kept there for 20 years and never used because it fits just right. And then another one is someone finally clears out their junk drawer, and then they need to plug in an old camcorder and can't find that wire. But that's extreme. We just don't use anything in the junk drawers or anything, and we were always worried about. That's why they're called junk drawers. Just like you said, the email is such a distraction. Deep Work by Cal Newport. And I think that book also believes that phones, I don't know if this is it's another book, but phones, the push notifications, that'll ultimately be regulated just like lead paint was, not overnight,
exactly.
Slowly. Yeah, because it's just so unhealthy.
Yep.
They need to figure out a way to do it. But just like paint, they couldn't overnight ban paint. They had to start fining people and taxing people to slowly get rid of it. Interesting stuff.
Oh, I was just going to say, I mean, I don't know when we're going to hop into the NAR stuff, but it's the NAR stuff is speculative and opinion based. You know, no one has any case law at this point beyond what occurred. I follow Mike Della Prete on LinkedIn, and he's a professor at Boulder in real estate, and also does a lot of really cool analysis, charts, graphs on all the real estate tech out there. And, you know, I thought he did a great post yesterday, which said, hey, you know, everyone's asking me to comment on this. I'm a fact-based, data-based person based on data and facts. I'm not going to give an opinion because everything right now is just an opinion. And it's so true, you know, and going back to the world of distraction is what he calls it. I believe that we're in a world of distraction. I think in the year 2000, you had to get in front of a consumer 4 times before they took action on something. And the last time that I studied this, I think it was at Tony Robbins' Business Mastery. There was a marketing day with Jay Abraham and some other people there. And they said that the number went to 16 times. And I think this was 2019 before somebody would take action on your ad or what you're doing to consistently get in front of them. I can imagine that number is probably doubled, tripled, quadrupled in 2024. So I think the secret to this whole NAR thing is going direct to the consumer and getting in front of them in a distracted world. If you can do that, you're going to be safe through this whole thing. It will be an opportunity for you. So while that's not really objective or subjective, it's kind of what I'm thinking, where we want to be positioned.
Well, and Bill, to add to that, kind of in parallel as well, you know, the realtors, there's some uncertainty. I mean, my wife's a realtor here in Dallas. And like you said, it's a lot of conjecture, a lot of opinion. Nothing's technically official. But from a loan officer standpoint, relationship, it goes both ways. And I think if you are in contact with those referring realtors or realtors in your area that you're friends with or acquainted with, show a little empathy, check in on them. Say, hey, as you hear information, keep me posted. We're here for you guys. I think that will go a long way, you know, on both sides of the fence of we rule the world, NAR, versus the loan officers and the MBA from an advocacy standpoint going out and, you know, offering up their opinion. There's always that middle ground of let's be nice and play together in the sandbox and we'll all be successful together.
Yeah, absolutely. And does it cost you more to get a mortgage to go through a realtor opposed going directly to a lender? You know, that's another question. You know, I don't have any data on that, but I will get some data and we'll see. But maybe that's something to think about too.
And my rant was about, I would assume lenders are less expensive, but when you now put this buyer's agent thing into it, and I was talking with somebody today, there's a place in Florida that is offering free buyer's representation at this realtor shop. So they're not going to charge you for any buyers, but they do want you to use their affiliated mortgage company. So, you know, that coupling of it adds a variable. And where I go against the grain a little bit, and I say it a little bit raw, so nobody on here technically agrees with me or has to. It's just my opinion. But I think all of our professions, like, we get a little bit too much into, okay, so on the real estate side, when you hear what they do, it's show property, it's the ability to negotiate, it's the ability to look at a disclosure if somebody's interested. It could be 120 pages. But to me, there's just like my father taught me, there's like always somebody better up the pyramid, more talented. So if it was really about that, then there would be a lawyer that's better at reading legal. I think when I hear you speak on a different podcast, the Housing Wire one, Bill, you talked about the grind and how consumer direct is a grind for loan officers and retail is a different grind, but it's a grind. And I think that's the separator is this is a grind no one else wants, whether you're a real estate agent or you're a loan officer. Their work is hard and worth the compensation because they are doing a grind that's very difficult for other people to wake up that day and know they got to make these calls or know they got to go visit this person that is probably not going to be warm to that. That is a grind that, you know, the person from Goldman Sachs is not going to come in and want to do to do a presentation of why a 30-year fix makes sense. That's why a lawyer's not going to want to come in and do a 126-page disclosure. They don't want to go through that grind. They have their own ways of making a lot of money. So let's talk about the grind as an economy. Where do you see this going? Could Consumer Direct, your team willing to get on the phones, this opportunity with NAR, people have to go show properties to people that it's not certain they're going to buy a home. What's the future of the grind economy in your eyes as the leader of grinding?
Well, I mean, hopefully not the grind app. No, I'm just kidding. Hopefully that's not around anymore. So yeah, I mean, I think Barry Habib did a great job of educating his team or his subscribers on what a buyer's agent does. It was in one of their updates in the morning. There's a lot that goes into that. You know, you can't just hire an in-house person to be the realtor for everybody in all 50 states. But yeah, it's definitely a grind. Will it be an avalanche of EPOs with rates dropping too quick, or will it be an avalanche of EPDs where the Fed oversteps? There's a lot of uncertainties, so you have to proceed with caution and grow with caution and make sure, you know, in terms of a value perspective, that profit is over growth, but growth is number two.
How do you mitigate against that, Bill, as a either broker or lender when creating profit, especially when we're talking about potential dropping? You know, we're going to be up and down this next few years. How do you mitigate against that for profit?
Against EPDs and EPOs, or just against?
Yes, against EPDs and EPOs, for sure.
Let me get in a better room with better Wi-Fi.
While you do get in the better room, what we're going to get into with Bill is his ability to find the riches in the niches, and talking about, and we've been saying it on our show, that another reason this NAR piece has made the industry vulnerable is a lot of lenders are selling to the same GSE loans. And if you heard like Andy Harris talk about it, Eddie Perez talk about it on our podcasts, if you're selling the same product, it's really just you're selling logos to get to that avenue. And the way you can differentiate yourself, and you know, I've been talking with some banks that want to do portfolio. Do they really need to do the conventionals as well, or could they broker that out? They do want to own the servicing. Jordan, this is where us retail, you know, lean on you for consulting. What do you see in the non-GSE world around servicing, and what would a lender look into if they want to start exploring going from very few non-QM to getting to where Bill is today?
Yeah, I think if in any situation, any relationship, you do your diligence to find somebody that's seasoned, has the experience, you know, something that's going to work well with your tech stack for, you know, ease of use and ease of process, and when choosing the right servicer. And even the same goes into the secondary and capital markets, right? In some of these non-agency products, non-QM, DSCR, which, you know, Bill's going to talk further on. I think the big thing there is just understanding, you know, what the underwriting guides are going to be. And if you have a delegated or a non-delegated relationship, it's just sticking to those. And that goes all the way back down to when you took that app, setting the expectations, you know. So the more you know, the more you'll grow. Education's power, all those things. And I think in that sense, from the LO to the lending organization, the more training that you can do on products and on guidelines really sets the stage up front to where the loan officer can tell somebody right up front that it's going to be a grind or, hey, you've got everything that qualifies. It shouldn't be no problem. And we'll close in our standard, you know, 15 to 20 day, you know, turn time. You know, again, back into the secondary and capital market space, that as well. Some of these non-agency products got a bad rap right when COVID started, and some of it went away and now it's back. But there were a number of providers that didn't go away. Just a few made the headlines that they went away, but there are plenty of people that were honoring their locks and funding the deals. And so it's just knowing and understanding the right partner when it comes to that, and being a little bit upfront with them, saying, hey, I need you to be transparent. How did it go during COVID? What did you guys do to stay successful, or did you drop out like everybody else? You know, I think people have to know and understand that with the market, the ups and downs, the high interest rates where we're at, these non-agency products are 1000% getting more and more popular, and they are actually being adopted. I think the last stat I saw is IMBs went from 1 to 3% non-QM production to now 8 to 10%. So LOs, broker shops, IMBs, if you're not adding non-QM to your process, then that is something that you are definitely missing out on. And to Bill's point, you can talk about volume, but profitability, I mean, these are trading anywhere from 102, 102 and a half to 104 in some cases, obviously depending on the credit profile, but it's a great opportunity. And it opens up an opportunity for you business owners for your LOs to have more products armed to hit the streets, beat the streets, and go out and do that true consumer direct, like Bill said, get in front of the consumer so that you can let them know what's available to them, especially those self-employed borrowers. I mean, it's just not understanding. They hear bank statement, or they're like, wait, what? They don't know that, right? So I think that's very important.
Yeah, 100%. I mean, we're 80% non-QM because people are not interest rate sensitive to non-QM.
And interest rates, I mean, 2 years ago, it was a good 300 bip spread. Now it's, right around 1, maybe just under, depending on what that pricing truly is. So there's flexibility, there's adaptability, and there's room for even an agency type borrower that might have one little hiccup to go non-QM and it be pretty smooth process.
100%. But yeah, Michael, I was just saying before I got cut off with my bad Wi-Fi in my office, to mitigate against EPDs and EPOs, have your MLPAs reviewed by an attorney would be my number one thing. And then also you got to watch out right now for strategic defaults. Those are coming back, so you got to prepare for those as well.
Yeah, and I was thinking that as you were talking about it, as Jordan was talking about the performance of non-QM mortgages out there, especially if they're selling at 102 to 104, I mean, that's got to be something that's got to be fearful. Jordan, this question is more for Jordan, but do you think that the non-QM products, like from 20 years ago, meaning that this, not necessarily stated income, but at least bank statements, do you think they're going to start getting a little bit more aggressive? And as more people enter in that space with more demand for that product, that pricing may even get sharper and follow a suit that agency is not?
I think you'll always have those investors that are willing to go out on a limb. They're trying to make that ROI for their investors, for their funds. Hopefully it doesn't get back to those ever-present ninja loans, no income, no job and assets. I mean, I was in the thick of that with being an AE at World Savings and Countrywide, where those non-conforming loans, it just got stupid. You had a certain credit score and you were breathing, you could get a loan with 20% down. It was just bonkers. So I think that there will be some more widening of guidelines as people try to clamor for market share in this non-QM space. But I think it's all going to be within reason. We've learned from the mistakes. Any kind of default event or credit event that happens will be nowhere near to the level of what happened back in 2008. And so I think that there is definitely a self-accountable measure with a lot of these investors and REITs that are putting the funding out there for these non-QM loans. And they're smart with it. They know better. And I think that there will be some widening, but not crazy. And I mean, just look at the volume. Last year, I think it was about 25 billion that was produced in non-QM. They're expecting 35 billion for this year and almost doubling up to 50 in 2025.
Hearing all of this, and to me, you said it on a podcast really well. One, when you were going out there as you pitched Mr. Wonderful and that they told you you're going to be in front of 7 million people. You got to keep it simple, like for the viewers. Then you talk about somebody I believe in and why I'd bet on you. I think more people need to get on the Alex Hermosi model, but you said he also kind of says to you in a book you read about the average person reads at, I think, 6th grade level, maybe. So I'm going to, as a viewer actually asked me to ask you this question, how to navigate consumer direct in a purchase market. So I'll just piggyback them. How do you make what Jordan just said so simple for self-employed people like me that are just jammed up, that we have an option, in a consumer direct model for purchase versus just refinance?
Yeah. I mean, Quicken spent trillions of dollars on trying to get 50% of their business to be purchase. Well, not trillions, but a lot of money. And the most they've been able to get it on their consumer direct is like 5%. We're at 50% purchase because people are able to find us directly We get builder turn downs because the in-house builder can't do the non-QM. So we're at 50%. And, that gives rise to the hybrid loan officer who's half retail, half consumer direct, getting fed leads.
So is that SEO? Is that execution on ability, like sales training on what to do on the phone call and asking for pain? What do you think separates you from somebody with all that money that can't even get in your, close?
Yeah, I mean, it's marketing, it's innovation, and it's sales mastery. So, your marketing, you have to be the best at getting in front of the consumer, converting the consumer, CRO, conversion rate optimization. You have to get your cost per acquisition down. You got to know these metrics, because if you don't know what you're doing, you're going to get your butt handed to you really, really quick. Whether that's an individual LO spending money on getting leads to go direct to the consumer and bypassing the realtor, whether they're retail or consumer direct or whatever the case may be, or a big mortgage company trying to create a consumer direct branch or department within the company. You've got to innovate, you've got to market, you've got to have a sales process in place. We have the 6-step roar and soar sales process that, every single person is trained on within the company. So yeah, it's again, consumer direct is a different grind. It's not for the faint at heart. It's a different hard than, I speaking of Housing Wire, I ran into Mike Cordes. I know he's in the news recently in the last couple of days, and I'm buddies with him. I've been on trip to the Masters with him. And I said to him, look, Mike, I can't do what you do. Like, I could never do what you do. I could never deal with 2,000 individual cowboy maverick work out of their garage loan officers. Like, good for you, man. Like, you're the man. Congrats. Now, what I do, I love it. I can have a direct impact on people. I can train them, coach them. I can make them a lot of money, but they have to follow the system. They can't just cowboy it and do it their own way, which obviously is way more risky, more lawsuits, more things going sideways, ununiform, lack of systems, lack of processes. So he does a really, really good job at, having thousands of loan officers out there. For me, that's a different grind, and a grind that I don't want to do. And I'm sure he feels the same way about my business.
Well, and Bill, and I think you said, earlier about just keeping it simple. The old school way of selling, said it on one of your earlier podcasts, Michael, about the art of sales is dead. And I think the mindset is we're all living this same economy. We're all dealing with these financial things that are happening in our personal lives, with our friends, our family. And, take it old school selling, empathize with the consumer. Like, hey, did you know, yes, you've got a 3% rate, but you've got $50,000 in credit card debt that's nearing 29%. I mean, there's no way it's going to take you 70 years to pay that off if you keep making the minimum payment. Here's what we can do, right? And do a little financial analysis for them. And that really ties into the self-employed borrowers as well. So it's one of those things where you just take the opportunity to really help them from a financial analysis standpoint to understand, yes, you're losing your 3%, 3.5% interest rate on your mortgage, but if you have assumed almost 200% equity increase in home appreciation, let's tap into that equity. Yes, you'll have a little bit higher interest rate, but we're getting rid of all of your debt, and this is going to save X, and that X savings over this amount of time until you can refinance again.
Yeah, and you just give them option A and B, a cash out refi or a HE loan. Let's do the math and let's see what works best for you. The numbers don't lie. And then guess what? If they do a HE loan that's only 150, 200 grand, it's a guaranteed first and second combo refi 6, 12, 18 months down the road. And so therefore you're getting a repeat customer.
So many people are, well, Mike, I'll let you say something real quick on that.
Bill, when you say HE loan, does that also include any of the first trust deed products that CMG used to offer as well as part of their equity accelerator product?
No, we don't do any of those.
Okay, so just HELOCs in general.
Yeah.
Then are you educating?
We're direct lender for HELOCs and HE loans. A lot of people only can broker them, and they don't want to do them because they make $200. we're able to maintain our profit margins and have the control over those and still save a lot of people a lot of money.
You got to call our friend of the show, Ralph Armenta, or you can reach out through us and we'll get you in touch with them. That's the only way you can be competitive, in my view. He'll get you in the right direction there on the HELOC. What were you going to say, Mike, before you had to drop?
By the way, I'm not even in the United States right now. But I was going to say is that you don't want to do like 2,000 like Nexa does, 2,000 originators. But like, how do you educate your originators to get a little bit more granular so that you can do more of those HE loans or non-QM so that, you know, that your borrowers can be more educated? How do you educate them differently from other IMBs or brokers?
Yeah, again, I mean, they're captive loan officers, they're W-2 employees, so they're trained to sell a certain way. You know, we had a group of loan officers that refused to sell them. And I'm like, look, you're throwing our leads in the trash, and I'm just going to go ahead and give this to another loan officer who will sell it, and you're not seeing the bigger picture. So as long as you get them to see the bigger picture, then they're fine at selling. And I think also, you know, Barry Habib has some great tools within MBS Highway that helps do the loan comparison tools. But at the end of the day, it's just math. As long as they're giving them the options and adding value, because that's what it's about. How can I find the pain point? How can I give you a solution? How can I add value and fix your problem so you can go with me? But yeah, I mean, it's a lot of product education that, you know, we have to go through with the team, because we do have a lot of products, you know, and we work with PE funds, insurance funds on the non-QM side. And, you know, most of it goes to 2 or 3 outlets. But if it's fringe or fairway, not fairway, or if it's fringe and it's a little outside the box, and I can go over my box with you guys if you want, then we're going to send it non-Dell and make sure we have 2 or 3 outlets for that non-Dell. Or if it's even really hairy, we're going to broker it from a risk standpoint. It just, you know, really depends. But most of our stuff, we try to stay within our underwriting box and our fairway, which we have a really easy to understand quadrant, if you will. So if anyone has a piece of paper, this is how we train our LOs. We have 4 boxes. This is old school underwrite. To Jordan's point about the subprime crisis, you know, one of the reasons that the whole thing blew up is that subprime rates became less than conventional A paper rates, and there was no longer a high enough yield to take care of the risk and the default for that risk. If the rates would have stayed at 9.4 to 12.4, which I think when I was selling 228s or 327s, the rates were, you know, 9.4 to 12.4, then those rates may have given enough yield to offset some of the default. So same thing here it's our philosophy of who's going to be a quality borrower. With non-QM, is there any fraud? Yes or no? Fraud, sorry, cancel, buy, because there is fraud out there right now. So you got to really, really pay attention to that. And then number 2, does this borrower have the ability to repay? And what we do is a quadrant. So the first box in the quadrant is LTV. So obviously on a bank statement deal, loan to value. So anything less than 90 on a purchase or a bank statement loan, you get a check for that box. Anything over 75 on a cash out, you do not get a check. If it's 75 or greater, you do not get a check in that box. And then the second box is credit, and that credit box needs to be 700 plus. It can't be any, you know, recent mortgage lates, 30-day lates, all the things that you look for. It's got to be 700 plus. And then you have DTI as the third box. So if it's over 43, you don't get a check. If it's under 43, you get a check. And then the last part is assets. And the most important about the assets part is it's not the cash you're giving them in hand that counts. It's what they have above and beyond that Do they have 12 plus months without the cash in hand? And then, of course, the fifth box, which is outside of the quadrant, could be anything that's a compensating factor that cancels it out. Maybe there's a huge NTB. There's a huge benefit to the borrower. Maybe they have a 660 credit score, but after you do this HE loan, you're paying off all the debt through escrow. You're not giving them the cash in hand. You're forcing them to pay off the debt. And then boom, that's going to be a 700. So we don't fund any loans unless we have 3 of the 4 boxes checked. And we don't deliver any delegated loans unless we have 4 of the 4 boxes checked. And if we only have 2 of the 4 boxes checked, we're either not going to do that loan or we're going to broker that loan. And we're going to make sure that that lender that we're brokering it to fully understands the risk of the file. And then we're on the hook for the premium, and that's it. So that's kind of how we train our loan officers to underwrite, to pre-underwrite the file. Is their brain turns into that quadrant, and they have that quadrant printed out on their desk, and they focus in on that quadrant. Now, you could apply it to conventional and VA and all that stuff, but this is just a non-QM quadrant.
Do you have this written down in your training manual? And is this something that, and I know this sounds almost insane, but is this something you'd be willing to share? Is this something you'd be willing to share at all to other originators or other IM?
Oh, the quadrant? Yeah, absolutely. We can all draw it ourselves right now, but I can definitely email it to anybody who wants it.
That's fascinating. And the industry focuses so much on the underwriting in the middle part. And I don't know if you want to talk about that, but I know you actually look at it. You remind me like how Jay Permisco almost yelled at everybody to do this daily at Housing Wire. And that was so cool that he did it. Like, somebody had to say it, and I'm sure others did it in the room, but it's always good to reinforce it. But you just have this talent that others are behind on. Another commenter wrote to me, you have the best SEO for a lender in the non-QM space in mortgage. So people can't get there, obviously, overnight. But what mindset for the up-and-coming originating IMBs or even brokers, what would be your kind of plan for them to go from focusing a lot on the underwriting costs to making sure that they are where the eyeballs are, where they are doing the right things to get the consumers without having to rely on real estate agents or refinances?
Yeah, look, I see we got Brian on here. FinLocker is one of those tools that you can leverage with SEO. You can leverage it with PPC. It's more of a top of funnel. So you've got to work that first-time home buyer or that move-up buyer or whatever the case may be through credit monitoring and alerts. And as long as you're in front of them, we're building out a whole cadence on top of what they're doing. And we've built out a lot of CTAs on the website with them. So a tool like FinLocker to get in front of first-time home buyers, because look, the NAR deal is now a race to the buyer. It's, everything's on the table, new models, new ways of doing business, new ways in getting the eyeballs in front of that new buyer. Who are the demographics for those people? Where are they at? What data can I buy? What can I do with this data and that data? I'm not saying you need a data scientist, but look, if you don't have the cash or the patience to go SEO, to go PPC, because the days of buying leads, that's dead. I remember all the people that, said in 2016 during the Brexit boom or 2020, hey, I don't need to talk to realtors. I hate realtors, F realtors, I'm not going to do that. And all they're doing is they're buying leads from LendingTree. Like, you have no differentiation. You're not adding any value, and you're just part of an ecosystem. So for me, do you have a real business if you're part of an ecosystem? I'll ask the group, do you think if you have a product that is on Amazon that does well and you're part of that ecosystem, or you're a consultant for Salesforce, and if Salesforce went away or if Amazon went away, do you have a real business?
My 2 cents on that is it all comes down to the relationship. Realtors have always done a good job. In fact, many people looking to buy a home go to the realtor first and not to the bank, not to the lender. It's always the realtor saying, do you have a pre-approval? Have you been vetted by a loan officer or bank? Show me your pre-approval letter. And I agree with you 1,000% that you have to be, if you want to put your market share above where you're at today and be like Bill and growing and turning a profit and this month being one of their best ever, you got to be willing to do that. And you talk about how you go about doing that. There's a very big trend and wave of people getting on video for the first time and being comfortable with it. Ali Carty does a great job on the, Gen Z side of things to inform all of us old dudes, how to touch that market and how to get in front of them. And if you're not on socials, then you're going to miss out there. But if you don't want to go on socials, then you got to get in the community. You got to go to your local, grocery store, retail chain. Every one of those are self-employed borrowers. And to be able to do straight P&L, to do written VOEs, to do asset-based or, lending, the DSCR, go out and market to all your buddies that are flipping houses and have a portfolio of rentals. Over 90% of all rentals in the United States are by mom pop investors. That is a huge market. And I think that that's just something that boils down to your ability and willingness to venture out, to adapt to the slowness of the market and go get your own market share in your own local community.
But I will say what you're saying is such an 80-20 rule, and we'll say 2-minute warning here, and we'll try and end it, even though everybody wants more. 80-20 rule, only 20% of loan officers physically are able to do that. I bet people are going to get better and better at this mousetrap. You got companies like CoStar now coming into the space, and they're going to be purposeful. You got NAR losing their edge with Realtor.com. And so lenders need to get better at controlling the mousetrap that is LendingTree, controlling the mousetrap that is CoStar. And there's only a handful of Griffin Fundings out there that have really mastered it, and it seems like the other companies are kind of stuck in their old ways and not maybe over-investing in that area to control the new world, which is you stay and you get in front of the customer and then somehow on their computer and their IP address, and once you know their IP, you can really stay with them for a long, long time if you know what you're doing. I wish I knew more what I was doing in that area, so I know thin out there, and I'm sure that is a big part of your scale plan, right, Bill?
Yeah, no, I think you can't be all things to all people, and you learn something new from experts every single day. We just hired a VP of marketing. She's on the call here. I can see her. And she's teaching me stuff. She's finding holes in the boat that need to be plugged. And, there's experts in all different areas. Look at UWM. There's, hey, you're a broker, you're an owner. Do you want to be the sales manager? You want to be the admin person? You want to be the state regulator person? Do you want to be the marketing person? Do you want to be in charge of processing, underwrite? We'll take all of that off your plate so you can go sell. Greg Shear did a great post with his HP 12C and talked about what a loan officer used to do opposed to now what a loan officer does is they're on TikTok and then they pass it off to their LOA and they don't even know. Like we hired one retail loan officer one time. And this person did not even know how to fill out a 1003, how to hop in our LOS and fill anything out because she worked for, I don't know if it was Guaranteed Rate or, one of those big retail guys. And she had somebody that did everything for her. So doesn't LO do all that stuff anymore? And people go to the UWMs of the world because they don't want to be all things of all people, and they hook into that Amazon ecosystem. Do they have a real business because they're not doing it all? No, I think they're smart because they're sectioning off of what am I an expert? What's my highest and best use, and how can I do that? Why would they go to Griffin Funding? Because, hey, Griffin Funding will market for me. We just hired another agency to do a PPC on a specific channel for us. And we learned so much from that new agency that we had no idea about. Can you afford an agency? Can you afford the longevity of SEO? Can you afford to be focusing 90% of your day on marketing? So really the business is prospecting, marketing, structuring deals, selling deals, closing deals, pitching deals is part 2. And then part 3 is the follow-up and the admin and the paperwork and everything it takes to get that deal closed. You can't possibly do all 3. you have a personality for one, you have, the highest and best use, you have the optimization for one of those three, pick one of those three. And whatever you're not good at or not an expert in, either decide to become the expert or work with a company like Griffin Funding where they provide all the leads. And then all you got to do is sell and close and pitch and structure deals and know your guidelines and know the loan quadrant. And then we, of course, take the last part and we efficiently process the deal. Our average non-QM deal closes in 36 days, which is unheard of. Or, you're a great marketer, you're great at sales, and you have UWM handle it all for you.
I think it's an exciting time for loan officers to embrace that they are grinders, and there's two different types, and you just hit both, and both will be successful, except I think your model is easier to scale and bring out and build up people. I think the other model is just always going to be the 80-20. And if you look at the stats that they're releasing and the amount of loan, I think we had it on our show the other day, the amount of loan officers that do 2.5 loans per month in 2022 were about 40,000 and change, and the amount of zip codes in America are 41,000. So there isn't even one loan officer per zip code that does 2.5 loans during that year on average. So I think...
You got that data from Ingenious or?
Yeah. And then I got the zip code data from Google. You one of your ads probably showed up along the way, but I did a little fun fact there. I appreciate you coming on here, Bill. Is there any fun final facts for those that stayed kind of a little bit later here that you could share, maybe about age, just people that are clicking or people that banner ads or video? Where do you think maybe the general audience has gone a little too overboard? Like, millennials do this, and you're like, yeah, they will do that. But really what we're seeing, any data you can share for final nugget that somebody might like to hear?
Yeah, I mean, it just always A/B test, always test your data. Know the riches are in the niches. Go after that niche as hard as you can. Get in front of them more than 16 times so they'll take action. It's probably 32 times at this point. And to me, like you guys said before, she who controls the leads, controls the world, controls everything here. So I think that you got to either find an expert or be the expert to get in front of people and just know who your avatar is. Do I want to go after that real estate investor who's 25% of the market? Do I want to go after that self-employed gig worker who, is upwards of 15% of the market now? Or do I want to go after that veteran who is 12% of the market, which is a very large 12%, by the way? Or what do I want to do? Who do I want to be, and what avatar do I want to go after? And it really forces you to say, what business am I truly in, and who do I want to go after, and who do I want to be, and what is my brand going to be, and what demographic? And then you can find ways to, what I call, it's not just an avatar, it's an ideal client. And when you find your ideal client, then of course that becomes a lookalike audience for you, and you can continue to go after it.
That is the chess that I am trying to get into the game, follow some grandmasters like you, because it just, the more you read like $100 million leads, you kind of see this is where some really bright people outside of our market are going. And the more we bring them in like you're doing, the more you'll get to the consumers first. The more you get to the consumers first, the more you'll be in control, as ultimately my little birdie's telling me in DC, it's now game on for that buyer data. The transaction itself, they could, that's not as important, but it does impact everybody. So thank you, Bill, for jumping on. Thank you, Jordan, for jumping on. This was a great show, great audience here on LinkedIn Audio. And I know the podcast, if you're listening, will get a huge, give us a like, a subscribe. This is brought to you by Bellix Valuations. Please reach out to Adopt the Brand to make an introduction. They are one of the largest appraisal firms. So if you got an AMC, they are not an AMC. And I think these appraisal conversations we're having need to have more of them. And if you are a large volume lender and you want to know where the puck's going, talk to me about Silverworks Solutions. That's all I have to say. So thank you both for jumping on. Appreciate the time. And thank you, everybody, for listening to More Talk. We'll be live again next Thursday at 2 p.m. Eastern.
11 a.m. Pacific.